move like this, that's a great profit. So, we should be able to get out at that position. Similarly, now you can see that earlier in April, the 5-day crossed below the 20-day. So you knew that the trend was moving to the downside. But now in the last couple of days, we've seen that the 5-day is crossing the 20-day again. So perhaps we watch this trend, and if in the next day or two, if the strength seems to be strengthening, then we can take a long position and go with the market. So that's how we look at moving averages. Now we could also look at longer term moving averages. Let me do that and show you what a longer term moving average would look like. So what we do is we just change the 5 to a 50. So this is going to be a 50-day moving average. And this, the 20, I'm going to change it to a 200. So we'll apply the changes, and now you see the difference. What you're going to see is you're going to see less choppiness in this moving average drawings. That's because the 50-day and the 200-day moving averages are not going to move that fast. So you can see that the 200-day moving average is the blue line, and it's almost horizontal. Even though the market's been going up and down, the 200-day moving average has been really horizontal. The 50-day moving average does go below the 200-day, and then now it seems to have crossed the 200-day moving average again at the end of January. So again, at the end of January, now this is a very long-term signal. So it's crossed the 200-day, the 50-day has crossed the 200-day, and it still seems to be on its way up. So the 50-day crossing the 200-day is a good long-term bullish signal. Now, but if you're looking at these charts, you cannot make trading decision based upon a few weeks or even a couple of months. You have to, when this 50-day crosses the 200-day moving average, your trade also has to have about a 200-day outlook to it. So yes, you could go long, but if you go long anyway here, once this crossed it, if you go long, just because it crashed in the beginning of March, you shouldn't be getting out of your position, because your trading outlook is much further along. Similarly, in April, we see that the markets have taken a pretty decent dip. But you wouldn't be out of this position, because from your outlook, the 50-day moving average is still way above the 200-day. And in fact, it's still on its way up. So the difference between the 50-day and the 200-day is increasing. So if you had a 200-day outlook on your trade, you would still be in this trade, even though it dropped here in early March, and then it dropped pretty hard in April. It dropped from 142 all the way down to 135. So that's about 75 S&P points. But you wouldn't be out of the market, because your outlook is still much more longer term. So this is how we look at moving averages. If you're a swing trader is somebody that has a 15-day to a 60-day outlook, then we go back to our charts of the 10-day moving average and the 30-day moving average. There's no real difference between the 5-day and the 20-day and the 10-day and the 30-day. So it's all personal preference how you want to look at your trades. If you think you're going to be in a trade for a week or two at least, then I would look at the 10-day moving average and perhaps the 30-day moving average. If your time frame is slightly shorter than that, then you can look at the 5-day and the 20-day. On the other hand, if your time frame is going to be slightly longer than that, then you look at the 20-day and the 50-day. So that's how we look at moving averages. So what I'm going to do now is to take off the moving averages from this chart.